Welcome back. So we're staying with earnings, and there are so many of them that have come through the weekend. And the next, stock and the next bank on our radar is IDFC First Bank. So let's look at, some of the key indicators and, of course, the key questions that we have for the management. Mr. We have Mr. Vaidyanathan joining in right now. Some of the points that the street would want clarity on would include, of course, the net interest margin picture. Can there be an expectation of better NIMs in the second half of the year? That's point number one. The bank has reported a very robust loan growth, 20% robust loan growth. So is that likely to sustain? And of course, we want to understand their ROA targets as well going forward. Mr. Vaidyanathan, thanks for joining in. First of all, season's greetings to you. Wish you, the team at IDFC First, and everybody back at home as well, a very, very happy and joyful Diwali. So let's start with the first point, that of course this quarter there's been a bit of a NIM compression, but in general the sense is that as that CRR cut kicks in, as loan growth picks up, NIMs in the second half, the overall financial system are expected to increase. Is that the view that you have for IDFC First as well?
Yes, this quarter we passed on the full impact of the repo rate cut that RBI had done to our customers. So that brought down the NIM to 5.59%. It is down 12 basis points. Q3 and Q4, we expect the net interest margin to actually improve. That's because our cost of funds is coming down and we expect it to come down.
Can you elaborate on that, Mr. Vaidyanathan? I mean, what sort of an improvement and how is this cost of funds coming down? What's taking it lower? What's your mix looking like now?
Basically, we brought down the fixed deposit rate quite sharply by about 100 basis points. So, and the fixed deposit rate usually takes about 1 year to about 15 months to fully pass on, because that's a typical tenor of fixed deposit. They come for repricing. Whenever they reprice them at a lower rate. So that is already brought down our cost of funds last quarter quite substantially. We expect it to further come down next quarter, further come down quarter after that. In fact, we are really thinking that for the first time in the bank's history, by Q4 of this year, our cost of funds will go to below 6%. We are very, very happy about that. And to mind you, we started at 7.8%. So that is already 160 basis points cut, another 20 basis point cut in the offing.
So by the time we end the fiscal, NIMs should go back up to what sort of a zone? Closer back towards, go on.
Upwards of about, today it's like 5.59. Definitely should go to like 5.8% or so is the number we are broadly working towards.
Okay, all right. Hi, Mr. Vaidyanathan. Always good to have you on the show, sir. Nigel on this side, wishing you, your team, a very, very happy Diwali and all at home as well. I wanted two numbers from you, sir. One is on the credit cost guidance. You've been guiding for better times ahead. So tell us what's the outlook out there. How do you see this credit cost number coming down? And the ROAs as well. As the year progresses, you're saying that it gradually moves up. So give us the targeted number with the timelines.
So let's take one thing at a time. Let's focus on credit cost. So even now, if you take out, microfinance is an industry issue. It happened to everybody. So ex-MFI, we're still in the zone of like 2.05%. We are guiding for the end of the year. And by the way, just to mind you, it is of percentage of loans. If you take it as percentage of assets, it's like 1.4 something percent. So of assets, meaning the whole assets. So coming back to the point, so it's already come down. It's like in that zone for the full year. Why it should come down to your question? Because the impact of microfinance is like going away. Q3, Q4, we expect very low credit cost in microfinance. So that's the reason why credit cost in H2 should be better, like much better than what it was in H1. And therefore, the whole year should look good, and we'll have a strong closing to the year, I'd say.
All right, just come back to the ROA number. You had said, I think, that it heads towards the 1% mark, right? You're holding on to that.
The ROA front, yes, of course, our bank, why one? We should go past 1.5% also in due course as the bank builds out. As of now, obviously when cost of funds comes down, net interest margin goes up. It should and credit cost also should come down. These are the numbers we're putting out. So naturally, we should see improvement in ROA, and we are more shooting towards 27 there we definitely feel that we will be in a very strong position. And, between 2018, 19 to 24, we saw a strong turnaround of the bank, and, that profit really took off. We almost get the feeling, I hope we come right, but we almost get the feeling that between this year to the next 4-5 years, we do get that feel about the bank.
So 1% not by the end of this fiscal. Is that correct? Now it'll be sometime in FY27.
27 certainly, but the end of the year we'll see where it goes. The direction should be definitely trending in the direction. Now, whether it exactly touches 110, 100 basis points, 1 or maybe 0.9 or 0.8. It's very hard to pick a number specifically on these things because there's so many moving parts. That's why I always focus on direction. I always focus on building the big blocks right: credit deposit ratio, borrowing, the capital. So we look at the big block items, and these things will fall in place. I can't pick a specific decimal, but direction is definitely good.
Mr. Vaidyanathan, let's talk about the loan growth as well. I mean, 20%. That's it's quite remarkable, right? So, is this the kind of number that you think you'll do for the full year? And also qualitatively, where's the confidence coming from, or the comfort coming from? Which are the segments where you're really seeing demand for credit pickup?
You can see now how the GST cut has really lifted off the game, and you've seen the numbers that have come from consumer durable companies, two-wheeler companies, car companies, consumption companies. So this is a big thing, and you see, if you notice, different players are placed in different parts of the ecosystem. Our bank is basically very indexed to the MSME growth. We are seeing good credit growth there. If you see, India's credit growth is only maybe 10 or 11, but if the MSME credit growth is like 18-20%. So we are there in that space, which is growing. The consumption business, which is all the durables and laptops and washing machine and refrigerator, we have developed really good capability. We are in that space that should grow. So we happen to be in areas which are the growth markets. It's just the sectors itself we are present is growing more, and corporate segment we are less indexed to. So that should, the fact that corporate credit is not growing very much shouldn't bother us very much.
Right. Mr. Vaidyanathan, good morning. Consumer loans, MSME is one area. The other is consumer loans, where this GST cuts, etc., were supposed to show up in a big way. And we're getting some feedback that it is showing up. Could you give us some sense of how big a lift this segment is getting or is seeing in your bank, sir?
The numbers in the public domain, right? Where different research houses, including SBI, IDFC, everybody's put out that consumption growth in the country, because of GST factor alone, is expected to lift by about 2 lakh crores. And we happen to be in that space, like I said before. That's one reason. Of course, the interest rates that came down, income tax that came down, all that put cash in the pocket, we know all that. The thing, if you see, since you asked specifically for us, where is our growth coming from? We are growing the loan book by about, let me call it, about 50,000 crores a year, but or in that zone, maybe 45 to 50. And 90% of this growth is coming from 4 areas. One is mortgages. That's growing by about 7,500 crores. Second is vehicle financing. That's growing by about 6,500 crores. Third is consumer financing. We talked about all those products there earlier. So that is about 6,000 crores. And then business financing, which is a small business, large business, even corporate banking, that's about 20,000 crores. So if you add these 4 numbers put together, you'll find 90% of our growth is coming from these 4 lines of businesses.
That's very, very helpful, Mr. Vaidyanathan. We'll leave it there, and we'll do a status check maybe in a month's time when you have a sense of how the festive season, and of course this is one of the best periods for financial institutions, for consumer spending, etc., as well, seasonally, because of festivals. So we'll do that. Thank you very much for joining us once again. Season's greetings and happy Diwali to you from all of us.
From all of us as well, to everybody and your viewers. And I must say that last year and a half or so went away talking about microfinance, this, that, book coming down, yield coming down, all that. It's taken away about a year and a half of our income lines, and that's why you saw profits are muted. I can safely say that next quarter after that, in 27, 28, 29, we see almost the same zone of growth coming back in profitability because the credit cost coming down and margins improving. So you should look forward for better days from IDFC.
Absolutely. And we certainly hope so. And we look forward to reporting on those better days and speaking to you as well. Thank you very much once again. Appreciate it.